While we have our annual cash flows calculated down to the before tax cash flows, one absolutely important thing in all discounted cash flow models is to consider the end of the event, the end of the project. Here we're assuming that we have a 5-year project and we want to work out what we're going to sell the property for and how much cash we're going to get from it. And so we need to do a number of other calculations now to work out what I'm calling the notional sale. The sale assuming we sell the property at the end of the 5th year. Okay, to do that, we can't use a DCF because a DCF will take us off into the future, maybe off into infinitely into the future. And so we have to use the simpler capitalisation method to calculate the sale price, notionally in 5 years' time. How do we do that? The capitalised value is taken from the operations in year 6. Okay? And it's kind of curious because people get very carried away with how important it is to use DCF because it's so much better than capitalised value. But in fact, we use the capitalisation method to work out this end sale value, end sale cash flow of the notional sale at the end of our investment horizon, our project length. Okay. We currently have worked out the initial net yield, and now we're going to forecast the terminal yield. Going to use the same approach overall as the initial yield, but we're going to take account of the fact that in some cases the yield will change. There are lots of reasons why the yield will change. Cyclical or fluctuations in the property markets, probably the most difficult to estimate. But the fact that investment properties usually consist of improvements on the land and the improvements wear out means that the yield is going to change as the buildings and other improvements wear out. Now, the effect of that on the yield rate is actually a little bit counterintuitive. That means that it runs backwards to what you would think. In most things, if something's wearing out, its value is getting less, you would say, well, the value is getting less, therefore the terminal yield should get less. In fact, it's the opposite. And the reason is that the rents tend to remain relatively constant, even though the building's wearing out. Yes, they may not accelerate quite as fast as the market in general, market growth, but the fact that you've got a tenant at all tends to keep a certain base level, if you like. And so it means that the rents don't appreciate quite as fast as the capital growth otherwise. Capital growth obviously is being affected because there is also the built-in need or expectation that there's going to be renovations or maybe even complete rebuilding in line. And so a notional purchaser would look at the property and say, yes, it's 5 years older than it was before, it's 10 years older or 20 years older, whatever it is the investment horizon is. And I'd say, I need to consider capital costs as a possible cost into the future, so I'm not going to pay as much for the property. That means that, oddly enough, the yield actually goes up. The rents are more or less constant, but the capital value is relatively lower, and so when you work out the division there, the bottom line's getting smaller, and so the answer is getting larger. Okay, long and short of it is that if you're going to be ambitious enough to forecast a different terminal yield to the initial yield, it will be a little bit higher. On commercial buildings over 10 years, often the rule of thumb is about an additional 1%. And so we could, for instance, say it's going to be the initial yield plus 0.01. What have I done? Didn't mean that at all. 0.01. Okay, 8.1%. Okay, that's on commercial property. If we're talking about a house, residential investment, that effect is probably going to be more modest. Commercial properties tend to need a lot more capital works, renovations, whatever. And so that effect tends to be a little bit larger. It's a matter of knowing the local market. Here we might put in 0.5% just to illustrate the point. But even that over 5 years is fairly unlikely. And so we may decide to have a forecast terminal yield the same as the initial yield. And I think that's what we will do here. We'll just take out the difference there and we'll adopt the same thing. But at least now you've got an idea why there's a separate box here. Again, depending on the property, if it is going to wear out significantly over the investment horizon, then you may want to jump that up just a little bit. You can do some calculations to work that out. For instance, if you're looking at a house and you're saying that in 5 years' time the kitchen might be a bit tatty, the bathrooms might need renovation, maybe the roof needs to be painted or whatever, and you can work out that's going to be maybe $100,000 worth of renovations, and you can work that back into an estimated yield. That's quite a science in itself. For our purposes, we simply have to admit, accept, recognize that there is going to be a terminal yield, and it may differ from the initial yield. Okay. Let's look at what that does to our capital value. First of all, let's look at the net revenue. And we need to calculate that. Now, why are we using net revenue? Well, let me go back to the initial net yield that we're looking at, and we see that the initial yield is worked out using our EBIT amount, so it's a net yield, and so we want to use a net yield for our notional sale. And so the like for like, I'll just take that out, come down here, our net revenue down here is equal to the net revenue in year 6. Okay, so we're doing like for like here. That means that we can capitalize that now. We take $22,000 divided by the terminal yield, another yellow highlight goes out. That's the preferred method of calculating the notional sale price into the future. A slightly simpler approach, which is suitable for some modelling purposes, is not to bother using the complexity of the DCF to do a capitalisation, but simply to say, we have recognised a growth rate of 3%. We bought the property for $270,000. So why don't we simply use 1 plus I to the n to grow the cost, the $270,000, by the market growth rate? So we'll do that. Okay, and that will be 1 plus I, which is the growth rate, raised to the number of years that we're looking at, and we take 5 there. Okay. Okay, and what that says is that if I buy it today, year 0, at $270,000, in 5 years' time it's going to be growing to $313,004. You'd be very ambitious to say that you've got the grown purchase price to the nearest dollar. However, that's the way it works. You notice there's a slight difference here between the two calculations. For the more thoughtful amongst us, you may want to give thought to why that is. The reality is that in this case especially, they're so close that you'd say, why go to all of the fuss and bother of having to calculate the year 6 estimates and then do a capitalisation and a terminal yield, when all I need to do is just grow the purchase price. That will be an interesting discussion point. However, we use the capitalised values for the cash flows from the year following the year of sale. Okay, so we're going to adopt the capitalised sale value of the future estimated sale price, and we'll say that's $314,000. We want to take off the sales fees because we want to work out how much capital gain we're going to be paying. And so to work that, we need the sale fees. Now, sale fees, you'll notice here, we haven't put the equation in here yet. Now we can. And we can say, how do we work out the sales fees? Well, we have an estimate and an allowance for sales fees of 3%. And so if we're selling the property for and earning $314,000 from it, we can work out the sales fees as simply 3% of that. And so we're going to write an equation. And you'll notice again that in all cases, my equations are in terms of cell addresses, not numbers. I can adopt the sales fees into there, and that means that overall the property now is actually going to net me about $305,000. Okay, now to work out my capital gains tax, the way that works is that the cash that I spend buying the property is subtracted from the cash that I gain by selling the property, and I pay capital gains tax on that amount. And the current rules are that I pay it at 50% of the general income tax rate. Okay, now what that means is that I need the entire number of dollars that it has cost me. And so this is equal to the cost, $270,000, to which has to be added the purchase costs, and the purchase costs I've got down here worked out, 275. So the taxable capital gain is going to be 314 minus the 9,000 and minus the 275,000. So I have taxable capital gain of 27,000, and the capital gains tax on that is worked out as the capital gain multiplied by the tax rate, in this case it's 0, but then also divided by 2 because of the current tax rules. And so we have 0. I'm just going to sneak in and put a tax rate in here just to demonstrate that that calculation works. And it is based on the tax rate payable.